What's up, everyone? In this video, we're going to be going over a very important data set that you're definitely going to want to keep your eyes on for the next couple weeks and honestly the rest of the year for the stock market and the economy overall. This was interesting. So this morning we had the jobs report for June come out. Basically, we saw non-farm payrolls in June increase by 372,000 when they were only expected to be increased by 250,000. This is awesome. It shows strength for the economy, right? That's a good economic signal. But something weird happened in the market. The second that data was released, the stock market tanked down, and then closer to open, it tanked down again. Why is that? If this is a good sign for the economy, a good sign for the market, why did it make stocks fall initially right when it was released? And the answer is because essentially right now we have very high inflation, right? And the Federal Reserve has a very tough job of balancing calming down inflation and not destroying the economy. So essentially, they want to get inflation under control and they would love for growth to stay positive. But the problem is when you try and calm down inflation, you kind of have to hurt the growth of the U.S. economy. So the Federal Reserve is just trying to balance the two of them so inflation gets under control and the economy stays intact. It's going to be a tough thing to do, but that's their goal. Now, what ends up happening when we see strong economic data like we did today, the Federal Reserve looks at that and was like, let's go. The economy is actually stronger than everyone thought. So that gives them the green light to continue to increase rates. When they increase rates, it helps calm down inflation, but it also kind of slows the growth. But as long as the economy is strong, the growth should be able to at least hopefully stay positive, and then inflation should hopefully start to calm down. So basically, long story short, because we saw a good jobs report, the Federal Reserve, it gives them the green light to continue to increase rates, which hurts the valuations of stocks, right? So whenever we see interest rates go up, it gives people more opportunity to invest elsewhere into other stocks and other investments overall, and it just hurts the present day value of, I guess you could say, future money or money 5 or 10 years from now from the investments you're making today, if that makes sense. So long story short, increasing rates hurt stocks, and the good jobs report gave the Federal Reserve the green light to increase interest rates theoretically. So check this out. Right now I'm looking at the US 2-year treasuries. Over the past year, they exploded. In the beginning of the year, they started out around 0.73%. Today, they're at 3.1%. Even though it doesn't sound like a lot, that is a ginormous increase, okay? When we see rates rising that quickly, it has a really tough impact on stocks because not only do increasing rates impact the current day valuations of stocks, but when the rates are increasing that rapidly, people ask themselves and they're like, all right, if rates just went from 0.73% to over 3% in the past 6 or 7 months, what's going to happen for the rest of the year? Are these 2-year treasuries going to be at 5%, 6%, maybe 7%? And people just get worried and scared, and that really hurts the stock valuations. So keep an eye on treasury yields. These are very, very important. To look at treasury yields, I like to go to CNBC. You just hover over the markets tab and click bonds, and then you'll see a bunch of different treasuries. The 2-year and the 10-year are some of the most popular. But anyways, when you see these rising by a decent amount, just like what happened this morning, most of the time that will have a bad impact on stocks. Not always, they're not correlated 1-to-1, but most of the time when you see giant pops in treasury yields, that hurts stock prices, okay? Keep that in mind. Realistically, in my opinion, we will continue to see rates rise throughout the rest of the year, but as long as they aren't rising at an explosive pace like they were over the past couple of months, then the stock market should have most of that priced in. So the main thing to keep your eye on are treasury rates or yield, whatever you want to call them. I know they're boring and a little bit complicated, but just head over to CNBC.com, maybe watch the 2-year or 10-year treasury every day or so, just check in on it, because that'll be a good signal as to what the stock market is pricing in, but also you'll be able to connect the dots on how rising yields impact stock prices. So keep that in mind. If you guys learned something from this video, make sure to subscribe. We have a bunch of other great videos planned, and if you have any other questions, let me know in the comments down below. But thank you guys so much for watching, and have a great weekend.